Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring. Today is Saturday, February 25th, 2023, and thank you so much for coming and visiting me for another edition of the Gossett and Trading Weekend Review. In the podcast today, this is going to be the format. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back. We are going to take a look at all the trades that I made in the previous week, both on the daily time frame and the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trades going forward. Hope you're doing well. Hope you had a good week. Trading week last week, yes, of course, we did have some movement to the downside, which I was kind of expecting actually, but I think there's some opportunities that are awaiting us to the long side in the coming weeks. Of course, we always have to pick our levels, position size correctly, know exactly where our end of day stops, emergency stops, know where our overhead resistance levels are, and just basically how to manage the trade. So I will show you. I hope that's helpful, kind of gives you a look into my mind as far as how I view trading. So we'll take a look when I bought, why I bought, and how I am going to manage the trade going forward. After that, we're going to switch gears. We're going to talk a little bit about trader psychology. I mention it every podcast, but it is so important, everyone. You know, I've been trading for 28 years. And after 28 years, you really understand. You can look back at your trading and go, you know, this is really all about mindset. And what I mean by that is having a good trading approach that uses good trading principles of position sizing correctly, giving yourself a good risk to reward ratio, having an emergency stop if it all hits the fan, and how to manage the trade going forward to the upside. But that's all about process. It's all about having if-then statements. If this happens, I'm going to do that. If that happens, I'm going to do this. You know, I wish we could all control the market. It would make trading very easier, but of course we have no control whatsoever, and we just have to deal with what the market gives us, and that has to be part of your approach. And that also what that really dovetails back to is your mindset and following your process. It's key that you follow your process, and that's all about what's going on in your head, not getting shaken out of a trade because you think something's going down or you think something's going up. It's just dealing with what you have. You know, I did a podcast, interview with Michael Lamothe last week, and I'll highlight this a little bit later in the podcast, but it all came down to mindset. And, you know, what he mentioned to me was that if he would have, he went back and did a deep dive on all his trading, and last year, if he would have just followed his process, it would have increased his return 20%. If you would have just followed it. So we'll talk a little bit about trader psychology, how important it is. After that, I will do a poem for my friend Frank, the trading poet. Always great poems, always kind of fun, and always pertinent to what's going on. After that, I have gone down through my master watch list, both on the daily time frames and the weekly time frames, and I have identified some levels that I will be interested in next week. You know, when I do this podcast, it's very rare that I say, okay, I have the trade now. I either have to wait for the stock or the particular market that I'm trading to go up, usually to show a little momentum, or down, and have that market prove to me that that level to the downside is rejected, gives me a good risk to reward ratio, and lets me put my trade on. So I do have some interesting setups that I'm looking at next week. I really like to do these on the weekends where the market's not open, lights, green and red lights are not flashing, and it's kind of a more holistic way of analyzing, setting your levels and going, okay, here's the level. I'm not messing with this thing unless it either goes up to this level or down to this level. It's really a great way to go. I mean, it really is. And so just waiting for the levels that I'll be identifying both on the daily and the weekly. If they get there, sure, I'll take the trade. If they don't, I'm just not going to mess with it. All right, so I'll highlight what I'm looking for both on the daily and the weekly. Hope that helpful for you. And that's what we're going to do. So first of all, I have to run the U.S. legal disclaimer. Hang tight for about 40 seconds, and I will be right back, and we'll get started. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Alrighty. Well, thanks for holding through that with me. As I mentioned last week, was kind of a win for the Bears. But we are coming back into some important levels that I think give the longs some interesting and good potential setups with good risk to reward ratio. So, in this podcast and when I show you these trades, I'm showing you the levels that I'm interested in. I have a lot of rules as far as managing the trade. I do my best here with the time that I have allotted to explain these to you. But I do want to mention to everyone, I do teach private one-on-one lessons in the evening time via Skype. In the course that I teach, the one-on-one course, I teach you all 5 of the different approaches that I use. I have 28 years of experience in putting together these processes. They all are good. They all include good trading principles. And if you are interested in learning how to trade, if you're interested in gaining a skill from someone that's been doing it for a very, very long time, please contact me. My email is in the link at the description. Reach out to me. We can set it up. The course is great. I teach you step by step exactly how to manage trades using good trades principles. I've taught people from all over the world for many years. I think they've all been very happy that they have taken the course. So if you're interested, please just reach out to me and we can set up a Skype call. We can talk about your trading and your trading goals, your challenges, and you can ask me a lot of questions about what I teach and what the format of the lessons are. But I think you'll be glad you did. It's an investment in yourself, and it's an investment in learning a skill. Let's get started. Okay, here we go. Qs. Now, Qs, we had this huge run up here on the Qs, on the PAL meetings and the PAL. What he was saying at the press conference, the market really liked it, really kind of got ahead of itself, got a little over its skis, and we have pulled back significantly. Well, I have been waiting for the Qs, the NASDAQ 100, to pull back and show me some kind of rejection of the 200 moving average or the 300 or the 250, everything, all the indicators that I use and levels that I use in the deep dip buy approach. And on Friday, we got there. There are a lot of buyers that tend to come in at the 200. It's a very, very key level. And you can see on Friday, you can see on Friday, it came down to the 200. It bounced at the 200. It showed that there were no more sellers available to make the market go down below the 200-day moving average. And it makes sense. That's a little bit of a self-fulfilling prophecy. I've been saying for weeks, hey, if the Qs get down to the 200, that's where I want to enter. I didn't want to enter up here. There were no levels, nothing telling me that I should get in. And that's what I was just mentioning before. When I go through the list today, it's the same process. I'm looking for the levels. If they get there, great, because they're important levels. They're significant levels. Doesn't mean they have to hold there, but if they do, they offer a good context and a good structure for a good risk to reward ratio. And that is what trading is all about. So yes, on Friday, we did get to the 200-day moving average. And I want to go through on this first trade and show you exactly how I set up a trade. If you get to a level like the 200, which happened on Friday, first of all, if you decide this is my level, I'm getting long, you have to decide how many shares am I going to buy in this particular market. So I have a really good approach that I use that not only factors in how many shares based upon the current market volatility, but it also allows me to know exactly what my emergency loss is and exactly what my end of day stop is. So let's start with the amount of shares. The first thing you have to do is you have to take, okay, what's my total capital? Let's just, in this case, just assume that it's $100,000, okay? Let's just assume you have $100,000 trading capital. What I like to do is I like to take 1% of the total trading capital. 1% of $100,000 is $1,000. Then I divide that by the value of the 2 ATR. This is 2 times the average daily range. So I take the hypothetical $1,000, which is 1% of $100,000. I divide it by the value of the 2 ATR, divided by 1330. This is exactly how I did it on Friday. And it shows that I would buy 75 shares. Okay, now, first of all, after you know how many shares you're going to buy, you have to decide, what is my maximum allowed loss? Well, we already decided it was $1,000, right? So I take $1,000 divided by 1330, tells me to buy 75 shares. Then I place my emergency stop exactly 1330 below that level. So if the market comes all the way down here, how much am I going to lose? I'm going to lose $1,000. That's what I already decided was the appropriate amount of maximum risk based upon my account size. Now, does that mean I'm going to lose $1,000 on every trade? No, it does not. As a matter of fact, only about 5% of the time will you lose the maximum allowed loss. It doesn't matter if it's 3% down or 20% down, that's still all you're going to lose. But that's only going to happen about 5% of the time. 95% of the time, your end of day stop is going to kick in. Well, what is my end of day stop? My end of day stop is usually exactly the opposite of why I got into the trade. I got into the trade because we bounced at the 200. Now, Monday, for example, if it closes below the 200, I am just out of the trade. That's it. I wait till the end of the day to make my buying and selling decisions, unless it's my emergency stop. If it hits my emergency stop, it doesn't matter what time of the day, when it is, what time frame. If I get there, I'm out. I've lost $1,000. So this gives me a very good risk to reward ratio here, because I now have the support of the 200 below me. Okay, so as it moves up, if it moves up, I take partial profits. I take 10% every time it moves the value of 0.45, which is now 299. So for next week, I will place a limit order 299 above the current closing price. And if it gets there, I'll take 10% off. Now I'll have a second profit target, which is my first profit target, using the 0.45 ATR added to that. That will be my second. I'll take my second. I'll add the 0.45 value to 99 at this point. Again, above that will give me my third. The emergency stop, the end of day stop, these are defensive maneuvers. Taking small profits into a move when it goes your way, those are offensive maneuvers. And you have to play, in my opinion, you should play, you have to play offense and defense in trading. Now I have the orange line up here. What is this? This is my trailing stop level. This is exactly 1.5 ATRs above my entry. If I get to this level, then everything changes. Then I go into trailing stop mode, because I don't want it to have to come all the way back down. But again, these are the rules. There's a lot of them, and how you manage your trade, to me, is the real difference between a winning trader and a losing trader. Okay, and again, this is what I teach in my one-on-one courses. So, and I'll show you many examples today of getting to the trailing stop level, and then that triggering, and I'll show you why it was so important and saved so much money. And then I'll also show you why taking partial profits on the way up is so important as well. So this is the trade. We bounced at the 200-day moving average. I position size using the 2 ATR. I place my emergency stop 2 ATRs below. I know where my end of day stop, which is simply a close below the 200. I have my trailing stop level 1.5 ATRs above. If it gets there, then I go into trailing stop mode. Now, I always like to look at multiple time frames to make my trade. Well, here we go. the dotted line, this is my entry point at 290.77 on the daily, dovetails right with the 200-day moving average. Let's go to the higher time frame on the weekly, because if I'm trading the daily time frame, I want to look at the weekly time frame to see if there are supporting levels also on the higher time frame. If I trade a weekly time frame, then I have to go to the monthly time frame to look for that. So again, just to be clear, here's the 200-day moving average. Here's my entry point right near the 200-day moving average. Let's go to the weekly and see, are there any support levels on the weekly? Because there are weekly buyers that will base their trades off of levels on the weekly. So showing that they could be some support or new buyers coming in on the weekly time frame as well, because the more buyers you have on multiple time frame, the better. Well, yeah, look, here is the 10 EMA on the weekly. On the weekly, we went below it, tested it, closed back above. This gives me some confidence that some weekly buyers are coming in here, or at least not selling, because it did hold the 10 EMA on the weekly. And then on the daily, we bounced at the 200. So I hope that makes sense. And so, yes, on the Qs, I entered at 290.77. It's 291.85. So thankfully that is already in the money. I identified my level that it bounced at the 200-day moving average. It's a good, strong level that the market watches. It rejected it. I position size by taking my maximum allowed loss divided by the 2 ATR. That tells me how many shares to buy. I place my emergency stop below. I know where my end of day stop is. It closed below the 200, and then to the upside now, I put my trailing stop level exactly 1.5 ATRs above. So this particular trade in the money already, 0.47%, not too bad for one day. And this is how I'll manage the trade. If next week, anytime it closes below the 200, I am out of there. All right. Okay. Microsoft. So Microsoft is a good example. As a matter of fact, there's a lot of good examples here for many reasons in this podcast. So I think you picked a good podcast. So Microsoft, I did buy Microsoft back on the 21st of February because it bounced at the 200. I position size, I placed my emergency stop below. If I bought the trade based upon a bounce at the 200, where am I going to get out for my end of day stop? That's right. Close below the 200. Well, that's exactly what happened the next day. So I entered at 252.30. The next day it closed below the 200. I got out for a very small loss, thankfully. Got out for a loss of about 0.43%. Now, the next day it closed back above. Could I have purchased this again? Yes, I could have. But, experience taught me something over all these years that I've traded. I did not like that, yes, we closed back above the 200, but we also rejected the 20. That gave me a little bit of pause, and I thought, no, there's some resistance there. I'm not going to re-enter that trade. And good thing I didn't, because now we are back down below the 200. In the coming weeks, if Microsoft closed back above the 200, didn't reject levels, give me a nice easy close, give me a good risk to reward ratio back into the trade, I would take it. But right now, not interested in the trade. But I did get out for a very, very small loss of 0.43%. Pfizer, oh boy, this one just did not work. But listen, there's going to be so many times where things do not work, right? In the last month or so, I've just had fantastic trades to the long side, but the market's changed. And so have had to give back and had some losing trades. Well, this is a perfect example. Okay, so I bought Pfizer with a higher low rejection of the 30 RSI. I bought here 43.46. My end of day stop is a close with an under 30 over 30. My end of day stop is a close below the 30 RSI, or if it hits my emergency stop. Well, as I mentioned, emergency stop only hits 5% of the time, but in this particular case, it did hit. So the next day I bought it, it moved up. Luckily, I took some profits off. I took a position off at profitable levels, which ultimately helped me because it mitigated to the loss to the downside. So took some profits here. A couple days later, took some more profits, thankfully, to help mitigate the loss. It kept coming down. It kept coming down. It never closed below the 30 RSI. And Friday, it gave up the ghost and it got to my emergency stop. Now, I did not wait till the end of the day. The second it got there, I just got out and lost what, in our hypothetical, $1,000, right? But actually, it wasn't $1,000 because it was less than $1,000 because I took off profits as it was going up. And that's one of the main reasons why I like to take partial profits, because if it does turn back around on you, it helps mitigate the loss. And those mitigations over years really add up. So did have to take emergency stop. Haven't hit an emergency stop for a while, but this week, unfortunately, did hit one here. So out of the trade for a 4.07% loss. UNG, oh boy. This one was insult to injury, I gotta tell you, and I'll explain why, but it happens. It really does happen. I took UNG with the close under the 30 RSI, close over the 30 RSI, V2 entry signal, which is something that I teach in my course. I was talking with a student of mine the other night. About 50% of my trades do involve a V1 or a V2 trigger, and it's kind of my bread and butter for trading. And by the way, on YouTube, on my YouTube channel, I have a video in there called V1s, V2s. It's completely free. There's a link in the description of this video. Go ahead and watch it, and they are really good entry signals. And I like to look for combinations, confluences of signals, and this was perfect. Under 30, over 30. V2 entry signal, rejection of the negative third ATR. I position size, I place my emergency stop, I have my trailing stop level above. Next day, started off great, took off some profits, thankfully, came back down, held the 30 RSI, held the 30 RSI, moved up again, took some profits, came back down again, moved up again, took some profits, thankfully, to help mitigate the loss. And then natural gas just went on a big down move on the 21st of February. I had to get out because it closed underneath the 30 RSI. You can see it got very close to my emergency stop, but it didn't quite get there. But then I took the loss because I have to follow my process. And then the market just rallies again, right? Insult to injury, it's okay. It happens. If you've traded for any length of time, you will see. You can't get upset about it. You just go, well, that's what happened. But at least I followed my process. So this was a very big loss, 14.44% loss, but dollar-wise, percent-wise, not that big loss, because even if it had got to my emergency stop, I still would have only lost $1,000. Makes sense? Got close, but it didn't. But percentage-wise, yes, it was a big loss of 1444. But again, taking partial profits when the market gives them to you really mitigated the loss. But nonetheless, not a great trade, but at least I did follow my process. Okay, those are the dailies. Let's head over to the weeklies and take a look. All right, well, weekly, really good trade on QLD. QLD is double leverage Qs, and I went to the short side. Why did I go to the short side? Well, because we rejected the 200-week moving average above. The market got up. There were no more buyers up here. This is a significant level, a significant ceiling of resistance above. And my thinking was, okay, the market tried to go up, moved back down, showing that there were no more buyers up here. So I got short here at 46.10. Now, position sizing, all that the same way. I took my $1,000, I divided by the value of the 2 ATR. That becomes my emergency stop to the upside, because in this case, I was short. Had it gotten up there, how much would I have lost based upon our hypothetical? I'd have lost $1,000. Where's my end of week stop? Simply a close above the 200-day would have got me out for a small loss. Well, it was a great trade. It's moved down. I took some profits off the next week, of course. And then this week with the big down move, also took some profits off. Now here's my 1.5 ATR trailing stop to the downside. If and when it gets there, then I will go into trailing stop mode, meaning that now in the future, after reaching trailing stop mode, if I have a close back above a previous bar's high, then I will get out of half. Okay, I know there's a lot of rules here, but again, if you decide to do the one-on-one course with me, I will walk you through very patiently all of the steps in all of these different trading approaches. Okay, so this particular stock, this particular trade doing well from entry to current price up 9.83%. So very grateful. I was actually looking quite diligently for some shorts because I had a lot of longs and I wanted to make sure that I had some balance to my portfolio, and in this case worked out really well. Currently profitable on this trade with the remaining shares of 9.83% profitable. SSO, this is double leverage SPY to the upside. I did get long SSO back here on the 6th of January with the close under, close over the 200-day moving average. I position size, I place my emergency stop below, 2 ATRs below, and my end of day stop, or in this case end of week stop, is simply a close below the 200-day moving average. Now, this is a very good example of showing why taking profits is so important as the market gives it to you. Up here, my 1.5 ATR trailing stop level, that's 1.5 ATRs above my entry. As the next week, it moved up, took profits. Next week, didn't do much. Next week, moved up again, took more profits. Next week, moved up again, boom, took more profits, significant profits. I took 2 profit targets on this particular move up. Then it got to my trailing stop level, which means then in the future, if I get a close below a previous bar's low, I will get out of half of the shares that I have remaining, not the original shares, because I've already taken off a substantial amount of profit in these bars. You see why that's so important? And then last week, we had a close below the previous bar's low after reaching trailing stop level. Got out a little bit before the end of the bar, so got a little bit better price and locked in 3.8% to the upside. Now, this was up much, much higher, but again, taking the profits, I did get some near the top. As a matter of fact, just from a logical standpoint, as you take profits to the upside based upon how I teach you to do that, you will always get some near the top. I mean, I definitely got some at the near the top or at the top. And again, it helps mitigate the loss to the downside if you turn back around, which we did. So rejection of the 200, emergency stop, end of day stops closed below the 200, 1.5 ATR trailing stop level, took profits on the way up to that. Now I'm in trailing stop level, have a close below the previous bar's low. I got out of half for 3.8% gain, and my end of week stop is simply a close below the 200. So we'll see what happens. IWM, boy, I've been in this one for a hot minute. It's been a great trade. Again, on the weeklies, I bought this all the way back on October 14th with a rejection of the 300-day, 300-week moving average. I position size, I placed my emergency stop, my end of day stop, just a close below the 300. It moves up, took profits, moves up, took more profits, got to trailing stop level. Now I go into trailing stop mode, looking for a close below previous bar's low. Didn't happen. Moves up again, took more profits. Looking for a close below previous bar's low. It finally happened here on the 9th of December, a close below the previous bar's low. Did lock in half for a gain of, looks like about 6.2% on the half position. Came back down, started to get close to the 300s, like, uh-oh, glad I took those profits when I did. But it held, kept moving up, took more profits, moved up again, took more profits. Of course, a few weeks ago, we had the big move up, took more profits, right? All at profitable levels, and now we have had this pullback. Now you might say, Greg, we did have a close below a previous bar's low. Did you do anything? No, because that only happened, it's only significant twice. And again, this is what I teach in my lessons, but the trailing stop level rules are getting to trailing stop level, close below previous bar's low, I get out of half. Now, at this point, a close below previous bar's low is only going to be relevant in another position if we reject the 70 RSI then I would take half. And then if I have a close below a previous bar's low after rejecting 70 RSI, then I would get out of the other half. Alternatively, if we move up, get to a 65 RSI and then close below the 5 EMA, then I would also be out of the trade. I know, sounds complicated, sounds like a lot of rules, but if you do study with me one-on-one, you will have this, you will know this like the back of your hand. Or as my friend Mel from Sri Lanka says, the front of your hand. I'm like, no, it's the back of your hand. But going forward here, what happens? Well, it's either going to get to the 65 RS level, close below the 5 EMA, now I'm out, or it's going to reject the 70 RSI, then I'm going to sell half. Then after I sell half, rejecting the 70 RSI, if we have a close below previous bar's low, I will get out of the rest. That's one way to the upside, or multiple ways to the upside that I will get out. Or conversely, if it closes back below the 300, I will get out of that as well. But the remaining shares on this particular trade still doing very nicely, up 10.76%. All right, CarMax, another good example. Now, this is a different kind of trade. Most of the trades I've been showing you here are deep dip buy approaches. This is a higher low V1. And again, V1s, V2s, so important. I did buy KMX back on the 20th of January with a V1. Here is bar 1, here is bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. That was my entry point at 65.14. Now, I position size, I place my emergency stop 2 ATRs below. My end of day stop is simply a close below halfway of the washout bar. Never happened. Got up here to my trailing stop level. At this point, I go into trailing stop mode. Of course, we had big moves up. I'm taking profits off as they happen, and now we got to trailing stop level, and then last week we had a close below of previous bar's low. So I got out of half of that position, thankfully, using that rule for a gain of 10.5%. And now this week we're down 7% from that week. So can you see why taking that the close below previous bar's low after reaching trailing stop level is so important? And again, the offense maneuver got some right near the high. Defense maneuver, trailing stop, locked in, thankfully, because we're down 7%. But the balance of this is still up 3.39%, but much, much higher on the trade as total in total because of taking offensive profits and because of the trailing stop rule that I used that I got out last week with the close below the previous bar's low. WBA. Well, I kind of feel like I've been married to WBA here because I have been in it for a while. I've been in it back since January 27th. Return to value V2 entry. A V2 consists of 3 bars. Bar 1, bar 2. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. Got in here at 36.90. Position size, emergency stops, 2 ATR below. Also got a dividend, which was nice. And end of day stop is simply a close below halfway the washout bar in the V2. This is the pink line. Well, you can see entered here. Next week, tested that halfway. The halfway is a very important level. Close back above. Next week, tested the halfway. Close back above. Next week, moved up, took some profits. This week, came back down again, but tested the halfway. You see how important that halfway line is? Of course, if it got to my emergency stop, I would immediately get out, but my end of bar stop on a V1 or a V2, regardless of the time frame, is a close below halfway of the washout bar. Washout bar closed 35.60. It closed at 35.80. I'm still in the trade. The trade is down 3.10%, but in actuality, it's not down that much because I did get a dividend and I did take partial profits. So still in the trade, looking for a close below halfway the washout bar, or alternatively, and ideally, if it moves up, I will take more profits. And once it gets to trailing stop level, I will go into trailing stop mode. Silver. Okay, this trade, not so hot tamale, but that's just how it goes in trading. I did identify my level. had an intraday rejection of the 200. I got long here at 1993, a position size. I placed my emergency stop to the downside, 2 ATRs below, and my end of week stop was simply a close below the 200. Well, it did that in great fashion on Friday. Metals have been very weak, but all I could do is identify my level, position size, place my emergency stop, know where my ended week stop is, and I did have to get out of silver here because obviously it closed below the 200 for a loss of 3.53%. Yep, kind of a tough week. Kind of a tough week. But the previous weeks have been outstanding. Now, here is a new trade that I took on AMD on Friday. Well, why did I take it? Well, we had this huge big bar up. The market understandably had some pullback, right? But you see how on the weekly chart we bounced at the 200. We just bounced. So that's showing me that for now, at least, the 200-week moving average is acting as support. You always want to get into a trade where you have support below you and less resistance above you. This gives me a good risk to reward ratio. Got in at 77.20. Position size, emergency stop, 2 ATR. My end of week stop on AMD is just simply a close below the 200. And if it closes below, I will get out for a loss. Hopefully it's a small one. Alternatively, to the upside, 1.5 ATR trailing stop level above. If it gets there, then I go into trailing stop mode. But in the meantime, if it moves up the value of 0.45 next week, which is now 3.38, I would take a portion off. I take 10% off. I will place 3 profit targets for next week, taking the closing price now, adding the 0.45 value to it. That will give me the first profit target. I'll take the first profit target, add the value to it again. That will give me the second. I'll take the second, add it one more time. That will give me the third. That's the offensive part. But I do like this on AMD, and so we'll just see what happens. And so far, this particular trade, up 1.17%. And then last but not least, UNG. Oh, I've got to show you another chart because the other one's a little messy. So I showed you I had the not so great trade on UNG, unfortunately, but it's a good teaching moment here. If you have a legitimate signal and it fails, and then you get another legitimate signal, do not be shy, at least I'm not shy, in taking the trade again. The previous one, the bad trade on UNG, was on the daily, but this one is on the monthly, and I'm sorry, on the weekly. Let me show you why I took the trade. Nice confluence of combinations of indicators lining up here. The main indicators, we went under 30 on the weekly, closed back above 30. You can see it's 30.52 on the weekly. So that is my main core entry signal. There's some contributing signals like a V1. I keep talking about V1s, V2s. And again, I teach you in detail in my course about V1s, V2s, and they are super handy and they really improve the chances of your trades being positive. Here's bar 1, bar 2, bar 1's low, bar 2 goes below, bar 1's low, closes above, bar 1's close. That's a legitimate V1 in addition to the under 30, over 30, and we also got above the negative third ATR channel. This is a very good setup. It doesn't mean it has to work, but the chances are higher. So I entered here at 849, exactly at the closing price. I position size, place my emergency stop 2 ATRs below, and then I place my trailing stop level 1.5 ATRs above. So, natural gas has been in a huge down move here. But, if you look back in time on natural gas, nope, sorry, wrong stock. So anyway, that's it. Under 30, over 30, V1, rejection of the negative third ATR channel, place my emergency stop 2 ATRs below. My end of day stop, or end of week stop in this case, will be a close below the 30 RSI, place my trailing stop above. So that is what's happening with the current positions, like the UNG weekly position that I took, like the weekly trade on AMD that I took, the bullish trade on AMD, with the rejection of the 200. And then on the daily, of course, I took the Q trade with a nice bounce at the 200-day moving average. All right, so let's get in. Oh, well, I'll tell you what. Let's do this first. I mentioned that I just had the interview with Michael Lamothe. Here it is on YouTube. It's a really good interview. If I can't say so myself, but Mike is a best-selling author. He's a great trader. He's a trading mentor and teacher, and he offers a lot of value. He has a new book called The Trading Mind Wheel 8. Uh, um, 8 essentials to become a profitable trader, and there's some really good wisdom in this. I will post this link in the description of this video, or you can just find it on my YouTube channel. But here it is. There's myself, there's Mike, and 8 essential skills for trading mastery. It's a good interview, so if you get some time, go ahead and check it out. I think you'll be glad that you did. Okay, trading psychology. Well, this trading psychology is a little long. Sorry, it's going to be long, but I think it's helpful. This is from Trading Navigator. Trading Navigator is the charting software that I use. I've used it for over 20 years. I really like it. I really enjoy it. I don't get anything from talking about this, but it's one of the great charting platforms, and I'm really glad I use it. And they come out occasionally. This just popped up, and I was like, oh, this is so good. I want to talk about this on the podcast. Let's see what it has to say. The power of stepping away. Trading can be an exciting and rewarding pursuit, but it can also be very stressful. When traders suffer multiple trading losses, it can be easy to become overwhelmed by setbacks and to fall into a spiral of negative emotions and bad trading decisions. Right? Good times. When this happens, it is important for traders to step away from trading and to focus on improving their mental and emotional state before returning to the markets. The first step for traders who are suffering multiple trading losses is to take a break from trading. Taking a break from trading gives traders the opportunity to step back and gain perspective on the situation. It allows them to review their trading plan and to identify any mistakes they have made that led to the losses. Taking a break from trading can also give traders the time and space to process their emotions and to develop strategies to address their mental and emotional state. All so true. Once traders have taken a break from trading, they should focus on rebuilding their confidence. Very important. This can be done through practices such as learning from their mistakes, developing new trading strategies, and research and studying the markets. It is also important to remember that trading is a long-term process and that it takes time to become a successful trader. It is important for traders to remember that setbacks are inevitable and that learning from them is key to becoming a successful trader. Finally, traders should ensure that they are taking proper care of their mental and emotional health. They can include taking time for relaxation, engaging in activities that reduce stress, and developing a support network of family and friends. It is also important to practice self-compassion and to remember that everyone makes mistakes and that it is part of the learning process. Overall, when traders are suffering multiple trading losses, it is important for them to step away from trading and focus on improving their mental and emotional state before returning to the markets. Taking a break, rebuilding confidence, and taking care of mental and emotional health are all important steps in order to become a successful trader. This is so well written and it's so true. I have been there. I have stepped away and it really does help. So if you have been through a drawdown, consider stepping away for all the reasons that I just mentioned by reading this here. It really does help. And I really do want to kind of give a shout out to Trade Navigator for a couple reasons. One, because this is such good advice that I wanted to share it with you. And two, Trade Navigator is a great trading platform. So consider using it. I've used it for over 20 years. So thanks again, Trade Navigator. And I hope this was helpful. Consider, if you're having a tough time, taking a break and, working on your emotional state, getting some perspective, and coming back to the market later with some new eyes. Okay, on to Frank's poem. Please follow Frank at FrankOD on Twitter. He writes a poem every day. They're wonderful, pertinent to what's going on. Let's see what today's poem is. Live by the sword, die by the blade. Sounds like the setup of a high-risk trade. That's true. A dangerous gamble will likely rain on your parade. Position sizing and management is how a trader gets paid. With my students in my one-on-one courses, I really try to pound this idea into their heads, and I'm going to try to do to you now. This particular poem is completely correct. Position sizing and management is how a trader gets paid. That's why I talked to you about how to position size, taking your maximum allowed loss, dividing by the value of the 2 ATR, knowing your emergency stops are, know where your ending day stops are, knowing how to manage the trade either to the upside and the downside. Live by the sword, died by the blade. This is totally gambling. You're either going to make it or break it. That's not the way to do it. Position sizing is so important. If you learn anything from this podcast, using the 2 ATR to tell you how many shares to buy in any particular market, depending on the time frame, is so important. And knowing where those levels are, right? Knowing where the levels are, emergency stop, end of day stop, trailing stop levels, overhead resistance level, position sizing correctly, taking profits on the way up. There's so many different components to successful and profitable trading, and that's why I keep talking about my course. This is what I teach in the course. I teach all of these things. I will teach you everything it takes to put yourself in the best position to be a profitable trader. So thank you so much, Frank, for the poem. Please follow Frank at FrancoD over on the Twit. All right, here we go. So these are the potential setups that I'm looking at next week. As I mentioned earlier in the podcast, generally the market is going to have to go lower. It's going to go higher, looking for some support level to the downside or some momentum to the upside. So this is why I like to do this on the weekend. I like to identify, oh, that's a level. It's not there yet, but if it gets there, then I'm in. And I also want to look at the higher time frame to look for some kind of support or supporting support or resistance if I'm going short on the higher time frame. So let's go ahead and do that. First on board is Apple. Well, Apple, always relish the thought of buying Apple when it rejects a major level, right? Or rejects a major level to the downside. Well, right now, the Qs. Right now, the 200 is at 146.77. We closed at 146.71. So we did not close back above it. But to buy Apple over the 200 historically has been good. It doesn't mean it's going to be in the future, but I like the setups. I like the back testing on buying Apple over the 200. And so next week, if we close above the 200 with a nice gentle close, if it closes up here, I'm not going to buy it because then I have a bad risk to reward ratio. But if I have a nice gentle close above the 200, I would definitely be entering Apple. Here's the line of the 200. Actually, it's down a little bit like that. Let's go ahead and take a look on the higher time frame and see if the level of the 200 on the daily dovetails with something on the weekly. Let's go to the weekly. Well, yes. Look, we have the 10 below. We have the 50 EMA on the weekly. If we close back above the 200 on the daily, most likely it will have closed back above the 50 EMA on the weekly. I like the support. I like that we're inside of the big bar on the weekly. I like that we're back in the value zone. So this all makes sense to me on multiple time frames. All I need for Apple, have a nice gentle close back above the 200, and I will be in. That's when I'll be following very carefully. Carnival Cruise Line. Okay, well, look, we just had a golden cross. That's when the 50 SMA closes over the 200 SMA. That's a long-term bullish signal. But what I've noticed is that whenever you have a bullish cross, not all the time, but a fair amount of the time, when you have a bullish crossover, golden cross, ironically, you'll get a move down before it heads back up. And what I've noticed is when you have the bullish cross or the golden cross, that a move back down to the 200 shortly after the crossover is a really good place to buy. Not always, but a lot of times. And so I am waiting for CCL to get back down here to the 200. One, because it's the 200. But what adds some sprinkles to this trade is that we had the bullish crossover. So the bullish crossover generally leads to a move down initially before you head back up. So I don't know if CCL is going to get down to the 200. But hey, I'd rather be buying it at 996 than up here at the top of 1266, right? I don't mean to laugh, because I'm sure there are people that did, and trust me, I've been there too. So I'm not making fun of that, but I'm just saying, much as we're sitting right now, the move back down to the 200 would give me a very good risk to reward ratio. So that's what I'm looking for on CCL, is a pullback, some kind of rejection to the 200-day moving average to structure my trade, to position size, place my emergency stop, and have a line in the sand with a close underneath the 200-day moving average. SPY, not SPY, Dow, DIA, Dow Jones Industrial. Here we go, 200-day moving average. It's not there yet, right? So I'm not going to do anything with it yet. But if it does come down to the 200, then I've identified the level. Okay, the 200 right here, 330, 323.60 on the 200. Let's see what that looks like on the weekly. Well, not great. I wish it had been at the -1 ATR channel or the 50, but it's still in the value zone, so it still makes sense. In the value zone, here's the 1 ATR channel, -1 ATR channel. Anywhere in between this green channel here is the value zone. Always want to buy in value, sell above value, or buy below value, sell in value. So the Dow Jones Industrial, I would be interested if and when, but only if and when it rejects the 200, that I'll be looking for a trade. FCX, all right, well, FCX is copper and gold mining. I've identified the level. Here's the 300-day moving average. It's not there yet. If it doesn't get there, I don't want to mess with it. But if it does get down there, that makes sense to me to buy it. If the market rejects it, either goes below it during the day, closes back above, or it closes below and then closes back above. Let's see where that 300 on the daily dovetails on the weekly. Nice. The 300 on the daily dovetails nicely in the value zone. There's some support back here from the price. There's also support of the 100-day moving average. I like it, but only and only if it gets down there. Gold. Well, I have been talking about gold for a while, and I said, hey, if we get down to the 300 or the 250, that's where I will be interested. Good thing I didn't get in earlier, right? Because it has just moved down like crazy. And on Friday, we did get to the 250, but we closed below it. So it's a no-go. 250 is 168.44. We're 168.37. Did not close below. Did not close above. So did not take the trade. But look, we're at a 32 RSI. We're at the 250. Nice confluence of signals. I just need it to get back over the 250. Let's see on the weekly where that dovetails. Dovetails nicely into this band of support with the 50 EMA and the 50 SMA back below and in the value zone. I like these trades, but I need the market to show me first that it's going to reject the levels and close back above. So next week, if gold does close above the 250, that will be interesting to me. I have a new student. He's a hedge fund guy out of New York City, and I wasn't looking at this, but I'm glad he pointed out to me. IBB looks really good. IBB is the biotech technology sector. That's his space in the hedge fund world, biotech, and this is the index of the major biotech companies. Here's the 200. Boy, we're getting close, right? It's a 2981 RSI. It's really sold off, but I really like this level next week on IBB at the 200. And of course, I drew the line at the 200. Let's see where that dovetails on the weekly. Perfection, man. Perfection. Look at the weekly. Has the 50 SMA and also has support of the -1 ATR channel there. So if we move down a little further and have a rejection of the 200-day moving average, I will definitely get in for surezies. But it doesn't mean it's going to hold, but it means that I can construct my trade and the 200 will give my line in the sand. But I like this trade very much, but it still has to show me some kind of rejection next week of the 200. INDA, my gosh. boy, this has been really weak. This is the index of the India stocks. We are at a 2738 RSI, so we are below 30. But you know what's interesting to me here? The double bottom with the bullish divergence. I studied one-on-one with Dr. Alexander Elder, and he believes that double bottoms, bullish divergences are some of the strongest technical indicators in technical stock trading. And I would agree, but it doesn't happen very often. But now this gives a very good opportunity. Let me kind of explain what a double bottom bullish divergence is. See the low here? You see how deep these red bars are? This shows that there's a lot of momentum to the downside. A MACD indicator is an indicator of momentum. So it's showing lots of momentum to the downside. Well, that's pretty clear, right? You can look at that and see. But now look, we are lower than this low. But you see how the red MACD bars are not as deep? This is showing that momentum to the downside is waning. And the implication of that is that you're running out of sellers. And if you run out of sellers, the implication is that you're going to move up. As a matter of fact, that's just if you run out of sellers, a market is going to move up. So the second leg down here with the MACD bars not as deep as the first level of MACD bars is showing that there's some waning of downward momentum. Now, just because you have a double bottom and a bullish divergence that is not an entry signal. You need a legitimate entry signal. Well, a legitimate entry signal would just be a close over the 30 RSI. 2738, I'm looking for a close back over the 30 RSI. So that is what I'm looking for. Close under, close back over the 30, in addition to the nice and beautiful double bottom bullish divergence here that's happening between this low and this low. As a matter of fact, there's also some other divergences. Here's the negative third ATR channel, fourth, fifth, sixth. Look at the prices here. We're down at the negative sixth ATR channel. Now we're lower. We're only at the negative 4 ATR channel. So not only do we have a double bottom bullish double bottom bullish divergence, we also have a ATR divergence, and we also have an RSI divergence. Here's the low. Look how deep RSI was. Now we're lower. It's not quite as deep. So that's the trifecta of divergences here. So I really like big picture what's going on here with INDA. I just need to close back above. And again, in my one-on-one classes, I teach you all about these divergences, RSI divergences, ATR divergences, MACD divergences, the whole deal. All right, Meta. I really do like Meta here because Meta, we had this big move up on earnings. Yes, we've moved back down, but you see, we've moved back down at a slower pace than the rest of the market. We don't have these big waterfall down candles. And that's showing relative strength compared to the rest of the market. This is another indicator that I use, is relative strength. Is the market stronger than the rest of the market? Well, I would say Meta is, just due to the fact that the bars, yes, it's come down with the rest of the market, but not sharply. So I'm looking for a level that would make sense to me right now is the 250 next week, which is down about 161.80. So it's still another $9 below, but that would make sense as a level, the 250. Some kind of rejection of the 250. Let's take a look and see what the 250 level on the daily, how that would dovetail on the weekly. Yeah, makes sense. Look at the support of the 50-week on the 50-week on the weekly time frame. Dovetails nicely with the 250 on the daily. These are important. It's important to line them up. So I'm looking for some kind of rejection of the 250 next week. Philip Morris. Well, Philip Morris, we are not at the 200-day moving average yet, but if we get there, that's what I will be looking for, about 95.80, a little less than $3 to the downside. If it just moves up, okay, let it go, have fun, Philip Morris. But if it comes down to the 200, yeah, I'm going to be interested. And let's see where the 200-day moving average level dovetails on the weekly, dovetails perfectly with the 50 SMA on the weekly. So it's a perfect multiple time frame setup. So if it gets there, I will take action. I'll position size. I'll place my emergency stop to ATR, and I'll have my end of day stop. Doesn't mean it has to work, but I position size correctly, and most likely if I'm wrong, I'm going to be wrong small. If I'm right, I could have a nice big move up, and that's what's important about trading. Rio Tinto, RIO. Okay, in the mining space with metals, all the way down here at the 200, 63.68. It's about $5 lower. I'm not buying it now. I'm just saying I've identified this level. Hey, it makes sense. It makes sense if it gets down there. And let's see where the 200 on the daily dovetails on the weekly. Yeah, has support of the -1 ATR channel on the weekly. So it all makes sense. But I don't know if it's going to get there. But if it does, it makes sense to me on multiple time frames, makes sense to me at a level. And that's how you set up trades, everyone. S&P 500. Well, I was looking for the S&P 500 on Friday. Any kind of bounce at the 200 on an S&P makes sense. Look, we had a golden cross over here. Remember a little while ago I said once you get a golden cross, you usually have a counter trend move to the downside. Happened again. 50 crosses the 200. That's long-term bullish, but it moved back down. So I'm looking for a close. I'm looking for some kind of rejection of the 200 next week. I don't talk a lot about trend lines, but there is a significant trend line that's going on here with S&P. Look, here's the bottom, here's the bottom, here's a bottom. Well, we broke down from that trend line, which is kind of a bad sign. And we tried to see the trend lines above us now. See how we tried to move back above? That is going to be acting as resistance now. So that could be a little fly in the ointment for the market, or at least for the S&P. But nonetheless, I am looking for some kind of rejection of the 200 next week. And then last but not least, Walmart is also what I'm looking for here. Not going to buy it here, certainly, but there is a confluence down here of the 250 and the 300 SMA down here about 138. Let's take a look and see how that dovetails on the weekly. Perfect. Has support of the 50 on the weekly. So that's what I'm looking for. So just a quick recap. Apple looking next week for some kind of gentle close above the 200-day moving average. Carnival looking for a move down and a test of the 200. Dow Jones looking for a test of the 200. FCX looking for a test of the 300 SMA. Gold looking for a close back over the 250. IBB looking for a move down and test of the 200. INDA looking for a close over the 30 RSI in conjunction with its double bottom bullish divergence. Meta just looking for some kind of move down and rejection of the 250. Philip Morris looking for rejection of the 200. Rio Tinto looking for rejection of the 200. S&P looking for rejection of the 200, and Walmart looking for rejection of the 250 and the 300. Now, if we have a move up next week or down next week, these are the 12 dailies that I'm looking for. They may all trigger. Does that mean I'm going to get into all of them? Absolutely not. I pride myself on getting into the best setup of the day. So if I had 12 setups, I'm only going to take one anyway. But I'm going to look and see on multiple time frames, all the indicators, which one had the most setups. Did one have a V1, V2, and the other one didn't? Well, then I would side with the one that had the V1 or V2. So I'm going to be looking at multiple time frames, going to be looking at multiple indicators, and the best risk to reward ratio. So I just want to be clear on that. I'm not going to take all 12 of these. I'm going to take the best one of the day. Okay, let's head over to the weeklies. And before we talk about the weeklies, I know I've been talking a lot about my course, but it's a really good course. And like I said, I have taught people from all over the world. They have been very happy that they've taken the course. If you are interested, please reach out to me. My email's in the link at the description. And if you do reach out to me and say, Greg, I'm potentially interested in your course, I'll reply and say, hey, thanks for saying hi. Let's set up a Skype call. The Skype call is completely free. It gives us a chance to talk about you, your trading challenges, your goals. It's a great time for you to ask me any questions about the podcast. And then once we're done with the call, then it's done. And you're going to have to reach back out to me after if you want to start the lessons. But the lessons are great. The course does cost $1,750, but it's worth every penny, everyone. I promise you that. I've had many people say, why is it so inexpensive? Like what you're teaching is worth a lot more than that. I'm like, yep, I know it is, but I like to try to keep it affordable for someone to learn. So if you're interested, I promise you'll be happy with it. I promise it's worth every single penny. So reach out to me. And by the way, if you like online courses, I have a great online course available at udemy.com. I teach you the deep dip buy stock trading strategy. I have sold so many of these courses all over the world. I've gotten so many good reviews and ratings and feedback on this course. And the best thing about this course is I teach you step by step. It's not as good as the one-on-one because it's recorded, but it's so affordable. It's only $12 to $15 on Udemy, and I teach you step by step how to trade the deep dip buy stock trading strategy. You know, and when the market made the low, that's trading strategy got me in at the very, very low. I'm not saying it will in the future, but it's a great strategy and it's very affordable. And that course is only $12 to $15. There's 26 videos, there's 15 study guides, and there's 26 videos total, 9.5 hours of video total. And if you're interested, the link's in the description for 12 or 15 bucks. I don't know how you'll do any better than that to really learn something. Again, not as good as one-on-one, because in the one-on-one, I teach you all 5 of the different trading approaches. This is only one trading approach, but keep that in mind. Okay, let's get to the weeklies. DDM. Now, weekly bars close on Friday. Okay, they close on Friday. Oh, sorry, that one shouldn't be there. Google. They close on Friday, so on weekly bars, I make my decision on the weekly bars on Friday. Now, Google, if we look at the weekly, my gosh, well, here's a deep dip buy for you here. I bought Google back here at, where's my line? At $87 with the rejection of the 250. Again, this is a deep dip buy signal. It was perfect. Rode that up all the way up here to the very top at 107. 83 to 107 simply using the 250. I got out because of earnings. And thank goodness I did, because look at that all the way back. But I've been talking about this. I have been waiting for Google to get back to the 250 because last time, look, over here it rejected the 250. Nice big move up. In this month worth of weekly bars, rejected the 250, moved up. Will it do it again? I don't know. But you have a better chance if you look back in time and the moving average was respected. So will it respect this time? I don't know if it will, but I'm looking very much forward to Google. It almost did it on Friday, but didn't quite get there. I want to see it rejected first before I get in. So this is one of my favorite trades for next week on Google. If we go under the 250, close back above, or at least if we bounce at it, test it and go back above. So looking very much forward to getting long Google if it rejects the 250 next week. Johnson & Johnson. Okay. Well, Johnson & Johnson has just fallen off a cliff. Clearly, these are weekly bars again, looking for the 200. Now, is it going to get there? I have no idea. But if it gets there, it makes sense. See, that's the point I'm trying to make. If it gets to the 200, it makes sense because it's the 200. It gives me a good structure to create my trade to. Let's look at the monthly, right? Because I'm trading the weekly. I want to look at the monthly. Yeah, look, the weekly 200 dovetails nicely with the monthly 50 EMA. Makes a lot of sense to me, but I have to be patient, wait for it to come down there. If and when it does, I will get long. Nike on the weekly. Well, Nike had a nice move up here and then pull back, which is to be expected. Just looking for some kind of bounce at the 200, some kind of rejection at least of the 200 SMA on the weekly. Where does that dovetail on the monthly? Yep, right in this nest of support of the 5 EMA, the 10 EMA, potentially the 50 EMA. So it makes sense. And again, if all of these weekly trades trigger, I'm not going to take them all. I'm going to narrow it down to the best one. All right. But looking for next week, looking for some kind of rejection of the 200 weekly SMA. Pfizer, well, I did not have a great trade on Pfizer, and I did have to get out last week, hit my emergency stop, same as I did with UNG. But again, on the weekly, what makes sense? The 200 week makes sense. It's down here at 39.40. It's a little over $2 below, but it would make sense. Good risk to reward ratio. Let's see where the weekly 200 lines up on the monthly. Exactly 50-month SMA. Makes a lot of sense, everyone, and that's what I'll be looking for. Qs, I already got long Qs on the daily, but from a weekly perspective, a pullback to the 200 would make a lot of sense. And it would also, you see the low of the range and the high of the range, a pullback to the 200 would essentially be very close to 50% retracement. So the Fibonacci's come in there as well. So I guess I have to put the line here. The 200 weekly, how does that dovetail with the monthly? Not perfect, but in the value zone, in the support level. But again, I'm long Qs on the daily, and hopefully that works out. If not, I can take another stab at it on the 200 on the weekly. Silver. Okay, silver has been weak. I got stopped out of my daily silver trade. But silver, looking for some kind of bounce or rejection of the 250 on the weekly or the 300 on the weekly. Tesla, been quite strong. Obviously, it's doubled, right? But a pullback to the 200 would make a lot of sense. And let's see where the weekly 200 would dovetail on the monthly. Yep, support of the 50 SMA below. And then last but not least, XLU, looking for a pullback to the 200. And the 200 on the weekly dovetails with, not perfect, but in the value zone on the monthly. So real quick, Google next week looking for rejection of the 250 on the weekly. Johnson & Johnson looking for a bounce or rejection of the 200 on the weekly. Nike, rejection of the 200, almost there. Pfizer, rejection of the 200. Qs, rejection of the 200. Silver, rejection of the 250 or the 300. Tesla, rejection of the 200. And XLU. Quickly wanted to cover just the indexes themselves. You know, last week, if you remember from the podcast, things started to look a little bearish to me. I was talking about the dollar. The dollar has really broken out here, and the dollar at this point in time is negatively correlated with the market. So as soon as we broke out, I started to think, I think the market is going to have some issues, because the higher the dollar goes, it's actually not a good sign for the market. So we have broken out. We are at, look at the dollar on the 200. If we could reject the 200 and come back down, that would be good for the market. So unfortunately, my analysis last week was correct, because the dollar broke out. I thought that's going to be weak for the dollar. And then also bonds going down. That is not good for the market. That means that we are our interest rates are going higher, not good for the market. But we are down at a pretty significant level. We bounced at the -30 ATR channel. So I think there's a good chance that we could bounce, TLT could bounce, or in other words, interest rates would come down. That would be good for the market. And then VIX. Well, VIX is a market of volatility. And when we had this big move up on VIX, that was concerning for the market as well. So all the negatively correlated markets broke out, which gave me the sense that the market was going to go down. Dollar broke out, but we're coming into some resistance. So that could be a good sign for the market. TLT down, meaning interest rates going up. Looks like we possibly could have some kind of bottoming pattern. That would be bullish for the market. And then VIX, we have not been able to get above this 50 SMA here. It's quite extended. Did have a pullback at the end of the day on Friday with VIX. if we want the market to go up, we want the VIX to come down. If we want the market to go up, we want TLT to go up. If we want the market to go up, we want UUP to come down. And they are all looking a bit toppy, so it's giving me a little bit of optimism that we are getting close to a low. I mean, we had a huge rally, a kind of a rally of a generation over the past month and a half. So this pullback that we have is not surprising to me, but I think that the pullbacks, based upon everything I showed you on the daily and the weeklies, we have this pullback to be expected, but we are coming into some support levels. Now, if those support levels hold, great. But if they don't hold, we need to get out and then look for a level deeper. So I hope this was helpful for you, everyone. If you have any comments or questions, please leave them in the comments section. If you like today's podcast, I would appreciate it if you could hit the thumbs up button. It does help to build the channel. It lets YouTube know there's some valuable content here. So if there's anything valuable in this particular podcast or anything valuable in previous, I would appreciate if you could just hit the thumbs up button, maybe share it on social media. It really does help out the channel. But the most important thing I always like to leave off with is please try to go out and do something nice for somebody today. You know, it really would make the world a better place if we could do one nice thing for another human being each day. And if I could also ask you if you could try to go out and do something nice for an animal, any animal that you come across. They appreciate acts of kindness. It's just good karma. So try to do one nice thing for another human being each day. Try to do one nice thing for an animal each day, and it really would make the world a better place. And you know, hopefully one day, if you need it, someone will be there for you as well. But check out the interview that I did with author Michael Lamothe. It's a great interview. He has great information as far as 8 essential skills for trading mastery. I've read the book. I really enjoy it, and I will put the link in the description as well. So have a great weekend. Hope you can get out, do a little exercise, maybe some chart study, maybe a little meditation, and God willing, I will see you next week. But enjoy your week, follow your rules, everybody, and I really appreciate you being here. Take care, and on the way out, I have to run the U.S. legal disclaimer. Bye, everyone. Have a good one. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance, Result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.